You know what's terrifying? Waking up one morning at 55 years old and realizing your entire financial life depends on one thing, your job. That's it. One income stream. One boss. One company that could decide tomorrow they don't need you anymore. I've seen this happen to brilliant people, hardworking folks who did everything right according to conventional wisdom, and it scared the daylights out of me. Here's the thing about being a slave to your paycheck. It's not just about the money. It's about freedom. It's about options. It's about not having to swallow your pride when your boss says something ridiculous because you're terrified of losing health insurance. That's no way to live, and you don't have to. I'm going to share 3 types of investments that changed everything for me and countless ordinary people I've known. Teachers, firefighters, nurses, shop owners. These aren't complicated Wall Street contraptions that require a PhD in mathematics. These are straightforward, understandable investments that work while you sleep, while you're at your day job, while you're on vacation with your family. The beautiful part? You probably already understand these businesses better than the so-called experts on Wall Street. You interact with them every single day. You just haven't been taught to think like an owner instead of a consumer. Real estate investment trusts. Let's start with something you absolutely understand: real estate. You live somewhere, right? You pay rent or a mortgage. You shop at stores that pay rent. Your doctor's office pays rent. Your kids go to a school that sits on land somebody owns. Real estate is everywhere, and it's been making regular people wealthy for centuries. But here's the problem most folks face. Buying rental properties requires serious capital. Dealing with tenants at 2 in the morning when the toilet explodes. Handling repairs, property taxes, insurance. Finding good renters who actually pay. It's practically a second job. Most people with demanding careers simply don't have the time or energy. Enter real estate investment trusts, or REITs. Think of them as a way to own a piece of apartment buildings, shopping centers, office towers, warehouses, medical facilities, even cell phone towers without ever unclogging a drain or chasing rent checks. Here's how they work. And it's brilliantly simple. A REIT is a company that owns and operates income-producing real estate. By law, and this is the beautiful part, they must distribute at least 90% of their taxable income to shareholders as dividends. 90%! Try getting that kind of payout from your typical corporation. You buy shares just like you'd buy stock in any company. The REIT collects rent from hundreds or thousands of tenants, handles all the headaches, and sends you dividend checks. You get the benefits of real estate ownership, income, and potential appreciation without the midnight phone calls about broken air conditioners. I remember talking to a teacher named Sarah who started investing $200 a month into a diversified REIT portfolio. She wasn't trying to get rich quick. She just wanted something beyond her pension. 15 years later, those investments were generating more monthly income than she made in her first year of teaching. That's the power of compounding dividends and reinvestment. Now, not all REITs are created equal, and this is where your everyday observations become incredibly valuable. You need to understand the story behind the REIT, what properties they own, where those properties are located, who the tenants are, and whether those tenants can keep paying rent. Take healthcare REITs. We've got an aging population in America that's not an opinion, it's a demographic fact. Older people need medical facilities, assisted living centers, skilled nursing homes. A REIT that owns a diversified portfolio of medical properties leased to creditworthy healthcare operators has a pretty compelling story. People don't stop needing healthcare because the economy hiccups. Compare that to a REIT heavily concentrated in shopping malls. You don't need me to tell you what's happened to malls over the past decade. You've walked through them. You've seen the empty storefronts. That's a struggling business model. And no amount of financial engineering changes that fundamental reality. Industrial REITs present another fascinating story. You order something on Amazon and it has to ship from somewhere. That somewhere is a warehouse. E-commerce has exploded, which means demand for distribution centers has exploded. A REIT owning modern warehouses strategically located near major population centers in lease agreements with Amazon, Walmart, Target, FedEx. That's a business model aligned with how people actually shop today. The beauty of REITs is the income stream. While you're waiting for that tech stock to maybe appreciate someday, a quality REIT is sending you dividend checks every quarter. That's real money you can reinvest or use to reduce dependency on your job income. I've known people who built their entire early retirement strategy around REIT dividends. They didn't need millions in the bank. They needed enough shares, generating enough dividend income to cover their basic expenses. Once your investments pay your mortgage, groceries, and utilities, Your job becomes optional. That's not being a slave, that's being free. When evaluating REITs, ignore the daily stock price gyrations. Focus on funds from operations, that's the REIT equivalent of earnings. Look at occupancy rates. If a REIT owns apartment buildings that are 95% occupied year after year, they're doing something right. If occupancy is dropping, find out why. Are they in declining markets? Are their properties outdated? Are competitors building newer, nicer buildings nearby? Check the dividend history. A REIT that's paid and increased dividends for 20 consecutive years is telling you something important. They run a solid business with staying power. A REIT that cuts dividends frequently is waving a red flag. Location matters enormously. A REIT with properties in growing Sunbelt cities where people are moving has better prospects than one concentrated in shrinking Rust Belt towns. You don't need complicated analysis, just look at where people and businesses are actually going. Debt levels matter too. Real estate is capital intensive, so REITs carry debt. That's normal. But excessive debt during rising interest rate environments can crush profitability. A REIT with a reasonable debt-to-equity ratio and staggered debt maturity shows management that thinks long-term. Dividend growth stocks. The second investment that can liberate you from job slavery is even simpler. Stocks of companies that pay rising dividends year after year. Not just any dividend stocks. We're talking about businesses so solid, so profitable, so shareholder-friendly that they increase what they pay you every single year like clockwork. This is where most people get investing completely backward. They obsess over stock prices, checking their phones 17 times a day, getting euphoric when it's up, depressed when it's down. That's exhausting and pointless. Stock prices are just opinions. They fluctuate based on mood, news, rumors, whatever nonsense some analyst said on television. Dividends are facts. A company either sends you a check or it doesn't. And when that check grows every year, something magical happens. You stop caring what the stock price does day to day because you're building a growing income stream. Let me tell you about dividend aristocrats. These are companies that have increased their dividend payments for at least 25 consecutive years. 25 years! That covers multiple recessions, market crashes, wars, financial crises, everything. And these companies kept raising dividends through all of it. Think about what that demonstrates. It shows profitability. You can't pay rising dividends without rising earnings. It shows management discipline. They're not blowing cash on stupid acquisitions or executive bonuses at shareholder expense. It shows business quality. Weak businesses can't sustain dividend growth through economic cycles. You already know many of these companies. Johnson & Johnson has increased dividends for over 60 years. Procter & Gamble, over 60 years. Coca-Cola, over 60 years. These aren't exciting tech startups that might change the world or might go bankrupt. These are boring, predictable businesses that make products people buy in good times and bad. Here's what gets me excited about dividend growth investing, the snowball effect. When you reinvest those dividends to buy more shares, which pay more dividends, which buy more shares, the compounding becomes absolutely extraordinary over time. I knew a bus driver named Tom who started investing $300 monthly into dividend aristocrats in his 30s. Nothing fancy. He picked 5 companies making products he understood and bought shares every month like clockwork. He reinvested every dividend. 40 years later, that portfolio was generating more annual income than he ever made driving buses. His salary from dividends kept growing even after he retired. He went from being entirely dependent on his employer to being financially independent. The key is finding companies with sustainable competitive advantages, what I call moats. You want businesses that aren't easy to replicate, that have pricing power, that customers genuinely need or want. Take waste management. Not glamorous, they collect garbage. But here's the thing, every household and business produces trash, and nobody's disrupting that fundamental fact. Waste management has contracts, landfills, collection routes, infrastructure that would cost billions to duplicate. They raise prices regularly because who's going to stop paying for trash collection? That's pricing power, and it flows directly to dividend increases. Or consider automatic data processing, which processes payroll for hundreds of thousands of companies. Once ADP is integrated into a company's operations, switching providers is a massive headache. That creates sticky revenue and consistent cash flow. ADP has increased dividends for over 40 years. Boring? Absolutely. Profitable? Extremely. Contrast that with trendy companies that pay no dividends and maybe never will. They promise growth and innovation and disruption. Sometimes they deliver, often they don't. Meanwhile, you're getting zero cash flow, entirely dependent on selling the stock at a higher price to some greater fool. Dividend stocks pay you to wait. Even if the stock price goes nowhere for 5 years, you've collected 5 years of dividends that probably increased each year. You got paid for your patience. The speculative stock that went nowhere paid you nothing. When selecting dividend growth stocks, I look for several things. First, a track record of consistent dividend increases at minimum 10 years, preferably 20 plus. 1 or 2 years of dividend growth proves nothing. Decades of increases prove the business model works. Second, a reasonable payout ratio. This is the percentage of earnings paid as dividends. If a company earns $4 per share and pays $2 in dividends, the payout ratio is 50%. That's healthy, plenty of room to raise dividends even if earnings stagnate. If a company pays out 90% of earnings as dividends, there's no margin for error. 1 bad year forces a dividend cut. Third, free cash flow. Companies can manipulate earnings through accounting, but cash flow is harder to fake. If free cash flow consistently exceeds dividend payments, that's reassuring. If dividends exceed free cash flow, trouble is brewing. Fourth, understandable businesses. If you can't explain what the company does and how it makes money to a 10-year-old, stay away. Complexity hides problems. Simplicity reveals quality. Fifth, reasonable valuation. Just because a company is wonderful doesn't mean the stock is worth any price. I look at the dividend yield compared to historical averages. If a solid dividend grower typically yields 3% but currently yields 4.5%, either something's wrong or it's temporarily out of favor, worth investigating. The psychological benefit of dividend investing cannot be overstated. When markets crash, and they will crash, dividend investors sleep better. Why? Because the dividends keep coming. Johnson & Johnson didn't stop paying dividends during the 2008 financial crisis or the 2020 pandemic crash. In fact, they raised dividends both times. Your paycheck from dividends doesn't care what the market's doing. That creates confidence to stay invested during turmoil, which is exactly when you should be reinvesting those dividends to buy shares at bargain prices. I've watched people abandon their jobs at 50 because dividend income covered their living expenses. Not because they hit some lottery ticket stock, but because they systematically built a portfolio of quality companies and reinvested dividends for 20 or 30 years. The math works if you give it time and feed it consistently. Here's what won't work: chasing the highest yield. Some companies pay enormous dividends as a percentage of stock price. Often that's a red flag. An unusually high yield frequently means the market expects a dividend cut. The stock price has crashed, pushing the yield artificially high. Buying high-yield traps is a recipe for disappointment. Stick with quality companies, reasonable yields, long track records. Boring beats exciting when you're building an income stream to replace your salary. Index funds. The third investment that can free you from job slavery is simultaneously the simplest and the one most people overthink: index funds. If REITs and dividend stocks feel like too much work, if picking individual companies seems overwhelming, if you'd rather spend time with your family than analyzing balance sheets, index funds are your answer. An index fund does one beautifully simple thing. It owns a piece of everything in a particular market index. A total stock market index fund owns shares of essentially every publicly traded company in America. An S&P 500 index fund owns the 500 largest companies. An international index fund owns companies across the globe. You buy one fund, you own thousands of businesses. Instant diversification. No need to pick winners or avoid losers. You're betting on the overall growth of capitalism, which historically has been an excellent bet. Here's what kills me about the financial services industry. They make investing seem so complicated that regular people feel inadequate and hire expensive advisors who frequently underperform a simple index fund. Study after study shows that over 10, 20, 30-year periods, the vast majority of professional money managers fail to beat a basic index fund after fees. Think about that. People spending their entire careers analyzing stocks with research teams, Bloomberg terminals, insider access, they can't consistently beat an automated index fund that just owns everything. It's almost funny if it weren't so expensive for investors paying those management fees. The reason is simple. Stock picking is hard, really hard. Even when you correctly identify a great company, you might buy at the wrong price, or the CEO might retire, or a competitor might emerge, or 100 other unpredictable things might happen. Meanwhile, an index fund doesn't care. Some companies do great, some do poorly, but the overall market trends upward over time. I talked to a couple, both public school teachers, who decided 30 years ago to put every dollar they could into a simple S&P 500 index fund. They didn't try to time the market. They didn't chase hot stocks. They automated their investment, a percentage of each paycheck, bought more shares regardless of what the market was doing. Through the 2000 dot-com crash, the 2008 financial crisis, the 2020 pandemic, they kept investing. Never sold, just kept adding shares. Today, in the early 60s, that index fund portfolio is worth over $2 million. They're retiring comfortably on teacher salaries because they understood one simple truth. Consistent investment in a diversified index fund beats almost everything else. The magic of index funds is that they remove emotion from investing. You're not making decisions about when to buy or sell. You're not reading headlines and panicking. You're not getting greedy during bubbles or fearful during crashes. You're just systematically owning a piece of the economy. Let's talk about fees because they matter enormously. A typical actively managed mutual fund charges around 1% annually. That might not sound like much, but over 30 years, that 1% fee can consume 20 to 30% of your potential returns through compounding. An index fund charges maybe 0.03 to 0.1%. That difference is enormous. If you invest $500 monthly for 30 years in a fund returning 9% annually, you'll accumulate about $900,000. But if fees reduce your return to 8%, just 1 percentage point, you'll have about $750,000. That's $150,000 lost to fees. That's real money. And for what? Most managed funds don't even beat the index. When you buy an index fund, you want low expense ratios and broad diversification. A total stock market index fund gives you exposure to large companies, small companies, everything in between. You own Apple and Microsoft, but you also own thousands of smaller companies. If the next Amazon is growing somewhere, you already own it. Some people worry that index funds are too passive, that you need active management to avoid disasters. But here's the reality. Indexes automatically rebalance. When a company shrinks or fails, it falls out of the index and gets replaced by growing companies. The S&P 500 today includes companies that didn't exist 20 years ago and excludes many that were dominant then. The index evolves and your fund evolves with it. The hardest part about index investing is staying the course during downturns. Markets drop sometimes, and it's terrifying watching your account balance decrease. But those downturns are precisely when your regular investments matter most. You're buying shares at discounted prices. Every share purchased during a crash has higher potential returns when markets recover. And markets always recover. Every single crash, correction, bear market in history has been followed by recovery and new highs. It might take months or years, but it happens. The people who got hurt are those who sold in panic during the lows and missed the recovery. I remember 2008 vividly. The financial system seemed on the verge of collapse. People I knew were selling everything, convinced we were entering a depression. Those who stayed invested, who kept buying shares through the darkness, saw extraordinary returns as markets recovered. Those who sold locked in losses and missed the recovery. Index investing requires faith in one fundamental concept over long periods. Businesses figure out how to make money and grow. Innovation happens. Productivity increases. Standards of living rise. The stock market reflects that growth. Short term, anything can happen. Long term, capitalism has shown remarkable resilience. You don't need to understand complex financial theory. You don't need to predict interest rates or economic cycles. You need to understand that owning productive assets, shares of companies making things people want to buy, has historically been the best way for regular people to build wealth. Some financial advisors will tell you index investing is too simplistic, that you need sophisticated strategies. Those advisors often make money from commissions and management fees, not from your investment success. They have incentives to make things seem complicated. The truth is, simple works. Buying a total market index fund or S&P 500 fund, investing consistently, reinvesting dividends, and holding for decades works. It's not exciting. It won't make great cocktail party conversation, but it builds wealth reliably. Combining all three. Now here's where things get really interesting. You don't have to choose just one of these investments. The most powerful approach is combining all three, creating multiple streams of income that collectively reduce your dependence on job income. Think of it like building a three-legged stool. Each leg supports the others. Your REIT holdings provide steady dividend income. Your dividend growth stocks provide rising income and appreciation potential. Your index funds provide broad diversification and growth. Together, they create a robust portfolio that can weather different economic conditions. Different investments perform well in different environments. When interest rates rise, REITs might struggle, but dividend stocks in certain sectors might thrive. When growth stocks are soaring, boring dividend payers might lag but provide stability. Having all three reduces the impact of any single investment underperforming. Let me walk you through a real example of how someone might structure this. Say you're 35 years old, earning $50,000 annually, and you can invest $500 per month. That's $6,000 yearly, which is very achievable for many people if they prioritize it. You might allocate $200 monthly to a diversified REIT index fund or a selection of individual REITs across different property types. Another $200 goes to dividend aristocrats, maybe 4 or 5 companies in different sectors buying shares monthly. The final $100 goes into a total market index fund for broad exposure. Every month, like clockwork, regardless of market conditions, those investments happen. In good months and bad, up markets and down, you're accumulating shares. Some months you'll buy when prices are high, other months you'll buy at bargain prices. Over time, you'll pay a fair average price, that's dollar cost averaging, and it removes the impossible task of timing markets. The dividends and distributions from your REITs and dividend stocks get automatically reinvested, buying more shares. This accelerates compounding. In the early years, those dividends might seem small, but they grow and grow. Fast forward 20 years, you're 55. That monthly $500 investment, assuming reasonable market returns, has grown to somewhere around $250,000 to $300,000, depending on exact returns. But here's the beautiful part. Those investments are now generating substantial dividend and distribution income. Your REITs might be distributing 4 to 6% annually. Your dividend aristocrats might yield 3 to 4% and growing. Even your index fund throws off around 2% in dividends. Collectively, you're receiving somewhere around $10,000 to $12,000 annually in passive income without selling a single share. That's nearly $1,000 monthly added to your budget without working an extra hour. For many people, that covers a mortgage payment or rent, or all utilities and groceries. That's significant. You've reduced your monthly dependence on job income by a considerable amount, but you don't stop there. You keep investing. Keep adding those $500 monthly. Keep reinvesting dividends. Another decade passes, you're 65. That portfolio has potentially grown to $700,000 to $1 million or more, generating $30,000 to $50,000 yearly in dividends and distributions. Suddenly your investment income rivals or exceeds what many people earn from their jobs. You're not dependent on an employer anymore. You can retire comfortably. Or work part-time doing something you love without worrying about salary. Or volunteer. Or travel. The choice is yours because you're financially free. This isn't fantasy. This is basic mathematics combined with discipline and time. The people who achieve this aren't special. They're not brilliant stock pickers or lucky lottery winners. They're regular folks, nurses, electricians, teachers, small business owners who understood these principles and stuck with them. The key obstacles aren't intellectual, they're behavioral. Most people fail at building wealth not because they lack knowledge, but because they lack discipline and patience. They start investing, markets drop, they panic and sell. Or they get bored with steady investments and chase speculative nonsense. Or they simply don't start at all because they think they need more money or more knowledge. Here's the truth: you don't need a lot of money to start. You need consistency. Investing $100 monthly starting at age 25 will build more wealth than investing $1,000 monthly starting at age 50. Time is your greatest asset, and you're wasting it every year you delay. You also don't need to become a financial expert. Understanding the basics I've outlined: REITs provide real estate income, dividend stocks provide growing income, index funds provide diversification is sufficient. The rest is just noise and distraction. What you do need is a plan and automation. Decide on an allocation that makes sense for your situation. Set up automatic investments that happen every month without requiring thought or action. Treat it like any other non-negotiable bill. Your future self is counting on you. One more critical component: tax optimization. Different account types offer different advantages, and using them intelligently can significantly enhance wealth building. If your employer offers a 401k with matching, that's free money, maximize it. Even if you think the investment options are mediocre, the immediate return from employer matching beats almost anything else available. After maximizing employer matches, consider Roth IRAs. especially if you're younger and in a lower tax bracket. Contributions are after tax, but growth and withdrawals in retirement are tax-free. Imagine your dividend and distribution income generating zero tax liability. That's powerful. For REITs specifically, holding them in tax-advantaged accounts like IRAs makes sense because REIT distributions are often taxed as ordinary income rather than qualified dividends. Sheltering them from taxes lets you reinvest more. Dividend growth stocks can work well in regular taxable accounts because qualified dividends receive favorable tax treatment and selling appreciated shares triggers long-term capital gains tax, which is lower than ordinary income tax. Tax laws are complex and change, but the general principle remains: use tax-advantaged accounts intelligently to keep more of your returns. Common mistakes to avoid. Let me share some painful mistakes I've seen people make so you can avoid the same traps. These errors have cost ordinary investors millions of dollars collectively, and they're all preventable with awareness and discipline. First mistake, chasing performance. Someone sees that a particular stock or fund returned 50% last year, and they pile in, assuming it'll continue. Usually, it doesn't. High recent returns often mean the investment got expensive. You're buying at the peak instead of the value. I knew someone who loaded up on tech stocks in early 2000 after watching them soar through the late 90s. Within 2 years, his portfolio was down 70%. He bought what was hot instead of what was reasonably valued. Meanwhile, boring dividend stocks and index funds continued their steady march upward. The correct approach is buying what's undervalued or reasonably priced, then holding while it performs. That requires patience and contrarian thinking, buying what others are selling, staying calm when everyone's panicking. Second mistake, market timing. People convince themselves they'll invest heavily when markets are low and sell before crashes. Sounds perfect in theory, impossible in practice. Crashes happen fast and unexpectedly. By the time you're certain we're in a crash, the worst damage is done. And markets often recover before economic news improves, so waiting for all clear signals means missing the recovery. The data is conclusive: staying invested beats market timing. Even missing just the 10 best days in the market over 20-year periods dramatically reduces returns. Those best days often occur during volatile periods when investors are most tempted to sell. A friend tried to time markets for years, moving in and out based on economic forecasts and technical analysis. His returns were mediocre at best, and the stress was enormous. Finally, he switched to simple index investing and stopped watching daily fluctuations. His returns improved, and his blood pressure probably did too. Third mistake, letting taxes drive investment decisions. Yes, taxes matter, but letting tax avoidance dictate strategy is foolish. I've seen people hold terrible investments because selling would trigger capital gains taxes. They'd rather lose more money than pay some taxes on gains. If an investment thesis has broken, sell and move on. Pay the taxes. Reinvest in something better. Holding garbage to avoid taxes usually results in losing far more than the tax bill would have been. That said, be tax aware. Harvest losses to offset gains. Use tax-advantaged accounts appropriately. Don't trigger short-term capital gains unnecessarily, but never let the tail wag the dog. Fourth mistake, inadequate diversification. Some people find one investment they love and put everything into it. Maybe it's their employer's stock, maybe it's real estate in one city. Maybe it's a single sector like technology or energy. When that one thing falters, their entire financial plan collapses. Diversification isn't just about owning multiple stocks, it's about owning different types of assets, different sectors, different geographies. Your REITs, dividend stocks, and index funds already provide good diversification if chosen wisely. Don't concentrate excessively in any single holding. I remember a guy who worked for Enron and had his entire 401k in Enron stock. He lost his job and his retirement savings simultaneously. Devastating and completely preventable. No single investment, no matter how promising, should represent more than a small percentage of your portfolio. Fifth mistake, paying excessive fees. Investment fees compound against you the same way returns compound for you. A seemingly small 1 or 2% annual fee becomes enormous over decades. Before investing in anything, understand all fees involved. Load fees on mutual funds, expense ratios, advisory fees, trading commissions, they all reduce returns. Index funds often charge 0.03%. Many actively managed funds charge 1% or more. Over 30 years, that difference can cost you hundreds of thousands of dollars. If an advisor can't clearly justify their fees with superior performance or valuable services beyond what you'd get from simple index investing, question whether you need that advisor. Sixth mistake, emotional investing. Markets go up and down, sometimes dramatically. Investors who make decisions based on fear or greed usually regret those decisions. When markets crash, fear screams, "Sell everything before it goes to zero." When markets are soaring, greed whispers, "Leverage up and buy more." Both impulses usually lead to losses. The solution is having a plan and sticking to it regardless of emotions. Your plan might be investing $500 monthly into your three-part portfolio no matter what headlines say. When you're tempted to deviate, remind yourself that the plan exists precisely for these moments. Seventh mistake, ignoring inflation. Some people feel safe holding cash or bonds yielding 2% while inflation runs at 3 or 4%. They're losing purchasing power annually while feeling conservative and prudent. Yes, stocks fluctuate in value, but over long periods, they've handily beaten inflation. Real estate and REIT investments generally keep pace with or exceed inflation. You need growth assets to preserve purchasing power over decades. This doesn't mean zero cash or bonds. Maintaining an emergency fund in some stable assets makes sense. But your long-term wealth building requires inflation-beating returns, which means accepting some volatility. Eighth mistake, starting too late or stopping too early. The most common regret I hear from retirees is wishing they'd started investing earlier. Compound interest needs time to work its magic. Starting at 25 versus 35 might seem like a small difference, but that 10 years of compounding is enormous. Similarly, some people invest diligently for a decade, then stop when life gets busy or expensive. They pause contributions during their 40s or 50s, precisely when they should be maximizing investments as kids leave home and expenses drop. Investment should be lifelong. Obviously, adjust amounts based on life circumstances, but don't completely stop unless financially necessary. Every year of contributions matters. Ninth mistake, trusting the wrong people. The financial services industry includes genuinely helpful advisors and also plenty of salespeople masquerading as advisors. Someone pushing expensive insurance products, proprietary funds with high fees, or complicated investments you don't understand might be prioritizing their commission over your interests. True fiduciary advisors legally must put your interests first. Fee-only advisors get paid for advice, not product sales. If someone's recommending investments that pay them commissions, at minimum get a second opinion. Better yet, educate yourself enough to know if advice makes sense. If you understand REITs, dividend stocks, and index funds, you can evaluate whether someone's suggestions align with sound principles or serve their interests. 10th mistake, giving up after setbacks. Markets will crash during your investing lifetime. You will experience years where your portfolio declines in value. That's normal and inevitable. What separates successful investors from unsuccessful ones isn't avoiding downturns, it's staying invested through them. Some people experience one bad year or one investment loss and quit, convinced investing doesn't work or they're cursed with bad luck. That's like planting a garden, seeing a dry week kill some seedlings, and declaring gardening impossible. Investing works. The principles are sound. The mathematics are proven. What's required is persistence through difficult periods and faith that productive assets create value over time. Real stories of financial freedom? Let me share some detailed stories of people who use these exact investments to escape job dependency. These aren't celebrities or finance gurus, they're regular folks who figured this out and stuck with it. Meet Jennifer, a registered nurse who started her career at 24 making $38,000. She wasn't frugal by nature and enjoyed nice things. But she made one non-negotiable rule: 15% of every paycheck went to investments before she saw the money. Early on, she split contributions between her hospital's 403B plan, the nonprofit equivalent of a 401k, invested in an S&P 500 index fund, and a Roth IRA where she bought dividend aristocrats. She picked companies whose products she used: Johnson & Johnson for healthcare products, Procter & Gamble for household goods, Coca-Cola because she loved Coke, McDonald's because it seemed to print money, nothing sophisticated. She bought shares monthly and reinvested dividends. Through her 30s, she barely paid attention to balances. Just verified contributions happened automatically. Her salary grew to around $60,000 as she gained experience. But her lifestyle inflated only modestly. Investment contributions grew with raises. At 42, Jennifer received a surprise inheritance from an aunt, $30,000. Instead of buying a new car or taking lavish vacations, she invested it all. She split it among her existing dividend holdings and added several REIT positions for diversification, a healthcare REIT owning medical facilities, an industrial REIT focused on distribution centers, and a diversified REIT with mixed property types. 5 years later, at 47, Jennifer did something bold. She calculated that her investment portfolio was generating about $18,000 annually in dividends and distributions. Her living expenses, kept reasonable through mindful spending, were around $35,000 yearly. She found a part-time nursing position working 20 hours weekly at a clinic, earning about $25,000 annually. Combined with investment income, she had more than enough to live comfortably. She went from 50-hour weeks in a stressful hospital environment to 20 hours doing less intense work, gaining 30 hours weekly of free time. Jennifer didn't retire in the traditional sense, but she achieved something better, freedom to work because she wanted to, not because she had to. At 52, she stopped working entirely when her investment income exceeded $40,000 annually, more than she needed. She's now 58, and that portfolio continues growing. Her dividend income is approaching $60,000 yearly without touching principal. She volunteers at a free clinic, travels regularly, and lives without financial stress. She never earned a massive salary or received another windfall. She simply invested consistently for 34 years. Or consider Marcus, who took a different path. He worked in construction, starting as a laborer at 20 and eventually becoming a foreman. Income was good but unpredictable. Busy seasons brought overtime. Slow seasons meant reduced hours. Marcus opened an account at a discount brokerage and committed to investing $200 monthly minimum, more when work was plentiful. He kept it simple, a total stock market index fund and a total bond market index fund, allocating 80% stocks, 20% bonds. No individual stock picking, no trying to beat the market, just systematic investing in broad index funds. During slow periods when money was tight, he sometimes reduced contributions to $100 but never stopped completely. He also took advantage of a union pension plan, contributing enough to maximize matching. Between his index fund investing and pension contributions, he was saving around 20 to 25% of income during good years. Marcus lived modestly, drove used trucks, and avoided debt beyond a mortgage. He wasn't cheap, he enjoyed fishing trips with buddies, and had nice tools, but he didn't confuse income with wealth. Some colleagues earning similar amounts had boat loans, new trucks every few years, and zero savings. Marcus had a growing investment account. At 55, after 35 years in construction, Marcus had a problem many would envy. His pension would provide about $35,000 annually. His index fund portfolio had grown to around $800,000. At a 4% withdrawal rate, he could take $32,000 yearly without depleting principal. His modest lifestyle required about $45,000 yearly. He had more income from pension plus sustainable portfolio withdrawals than he needed. He retired 5 years earlier than the typical retirement age, in good health, with decades ahead to enjoy it. Marcus wasn't brilliant or lucky. He followed a simple plan consistently through recessions, market crashes, job changes, and life challenges. That consistency over decades created financial independence. Then there's Susan and Mike, a married couple who combined strategies. Susan was a teacher, Mike worked for a telecommunications company. Combined income ranged from $70,000 to $90,000 throughout their careers, depending on Mike's overtime and Susan's summer school teaching. They started investing seriously in their early 30s after reading about dividend growth investing. They selected 10 dividend aristocrats across different sectors: consumer goods, healthcare, utilities, industrials, technology, and committed to buying shares of each company quarterly with $100 per company. They also maxed out Susan's 403B plan with a total market index fund and contributed to Roth IRAs annually. As Mike's income increased, they added REIT positions to the mix: a residential apartment REIT, a retail REIT with grocery-anchored shopping centers, and a cell tower REIT. Their strategy was dividend reinvestment during accumulation years, then living off dividends in retirement without selling shares. They tracked something simple: total annual dividend income. Each year they calculated how much their investments distributed. Year 1, maybe $2,000. Year 5, perhaps $6,000. Year 10, around $15,000. Year 20, approaching $40,000. The growth accelerated as the portfolio compounded, and they kept adding new money. By their mid-50s, Dividend income exceeded $30,000 annually and growing about 7 to 10% each year as companies raised dividends and they reinvested distributions. Combined with Susan's teacher pension and eventually Mike's Social Security, they had more retirement income than they needed. They retired at 58 and 59 respectively, younger than many peers, still grinding away because they built multiple income streams that didn't depend on employers. Their portfolio continues growing even though they've stopped contributions. Dividends compound and increase, providing rising income to offset inflation. What's common among these stories? None of these people had massive salaries or windfalls. None timed markets perfectly or found the next Amazon. They simply understood basic principles, started early or committed fully when they started, remained consistent through market cycles, and let time do the heavy lifting, getting started today. Knowing these strategies intellectually means nothing without action. The gap between knowing and doing is where most people fail. So let's talk specifically about how you start building your freedom portfolio this week, not someday when conditions are perfect. First, figure out your current financial picture honestly. What do you earn monthly after taxes? What do you spend on needs versus wants? Most people have no idea where money goes. Track spending for a month, everything from mortgage to coffee. You'll find leaks, guaranteed. The goal isn't extreme frugality or deprivation. It's finding the gap between income and necessary expenses, then dedicating some of that gap to investments. If you're currently saving nothing, finding $200 monthly might require tough choices. Cancel subscriptions you rarely use. Cook more meals instead of dining out. Drive your car another year instead of upgrading. If you're already saving some money but it sits in a checking account earning nothing, you've found your investment dollars. Money sitting idle is wasting potential. Second, open the right accounts. If your employer offers a 401k or 403b with matching, start there, set up contributions to capture the full match minimum. That's instant return before any investment gains. Open a Roth IRA if you're eligible. For 2025, you can contribute up to $7,000 annually if under 50, $8,500 if 50 or older. That's about $580 monthly or around $700 monthly for older savers. Most people can do some portion of that. Use a low-cost brokerage. Fidelity, Vanguard, Charles Schwab, all work fine. Avoid anyone charging account fees or high commission structures. Modern discount brokerages charge zero commissions on stock trades and offer excellent low-cost index funds. Third, set up your investment allocation based on age and risk tolerance. If you're younger with decades until retirement, you can handle more stock exposure and less bond allocation. A simple starting point might be 80% stocks, 20% bonds in your 30s, shifting gradually to 60-40 or 50-50 as you approach retirement. Within that stock allocation, distribute among your three strategies, maybe 40% total market index fund, 30% dividend growth stocks, 30% REITs, or 50% index, 25 each dividend stocks and REITs. There's no perfect formula. The key is diversification and sticking with the plan. Fourth, automate everything. Set up automatic monthly transfers from your checking account to investment accounts. Set up automatic purchases of your chosen investments on specific dates. Remove the decision-making from the equation. You wake up on the 15th of each month and your investments happen without thought or action. Automation defeats procrastination, emotion, and forgetfulness. It ensures investing happens during busy months, stressful periods, market turmoil, all the times you might otherwise skip it. Fifth, educate yourself gradually, but don't use education as an excuse for inaction. You don't need a finance degree to start. You understand the basics now. REITs provide real estate income. Dividend aristocrats provide growing income. Index funds provide broad diversification. That's sufficient to begin. As you invest, you'll naturally learn more. Read annual reports from companies you own. Understand what they do, how they make money, what risks they face. Over months and years, you'll develop deeper knowledge. But don't delay starting while trying to become an expert. Sixth, prepare mentally for volatility. Your account balance will fluctuate. Some months you'll see red numbers and declining values. This is normal. Markets go down sometimes, and down markets are actually opportunities to buy shares at discount prices. The only investors who get hurt badly are those who sell during downturns. If you're young or middle-aged, market crashes are gifts. You're accumulating shares at lower prices that will appreciate over your remaining decades of investing. If you're closer to retirement, that's why you gradually shift toward more bonds and stable investments. You reduce volatility exposure as you have less time to recover from major downturns. Seventh, increase contributions over time. When you get a raise, immediately increase your investment contributions before lifestyle inflates to absorb the extra income. If you're investing $400 monthly and receive a raise that adds $300 monthly after taxes, bump investing to at least $600 monthly. This requires discipline because it's tempting to upgrade lifestyle with every raise, but lifestyle upgrades provide temporary pleasure. Investment contributions build permanent financial security. Choose wisely. Eighth, review annually but don't tinker constantly. Once a year, check if your allocation has drifted significantly. Maybe your index fund grew faster than your dividend stocks, shifting your desired allocation. Rebalance by directing new contributions toward whatever's underweighted. But don't check daily, weekly, or even monthly. Frequent monitoring increases anxiety and tempts bad decisions. Your portfolio is a long-term vehicle, not a daily scoreboard. Ninth, protect yourself from your own potential mistakes. Tell trusted friends or family about your investment plan. Having accountability helps you stick with it during tempting moments. Write down your investment philosophy and reasons for your strategy. When market crashes tempt you to panic sell, reread your reasoning from calmer times. Consider automating so much that making changes requires deliberate effort. Having to manually log in, verify identity, and execute trades creates friction that prevents impulsive decisions. 10th, celebrate milestones but stay focused on the destination. When you hit your first $10,000 invested, that's exciting, acknowledge it. First $100,000 is a huge psychological milestone because compound growth accelerates dramatically after that point. But don't let celebration morph into complacency. The goal isn't a big number in an account. It's financial independence, the point where investment income covers your lifestyle expenses and your job becomes optional. For some people, that number might be $300,000 generating enough income combined with other sources. For others, it might require $1 million or more. The number varies based on lifestyle and goals. But the path remains the same, consistent investment in income-producing assets over many years. What financial freedom actually feels like. I want to end by describing what financial freedom from these investments actually feels like day to day, because it's not what most people imagine. It's not waking up and checking your balance, giddy about numbers going up. It's waking up and not thinking about your balance at all because you know the system is working in the background. It's not quitting your job dramatically and sailing around the world, though you could. For most people, it's more subtle. It's having a terrible meeting with a boss who's being unreasonable and thinking, I don't actually need this, instead of swallowing frustration out of fear. It's your company announcing layoffs and feeling concerned for colleagues, but not terrified for yourself, because you know your investment income plus unemployment would cover expenses while you find something else. It's being offered a job you'd love that pays 20% less than your current role and being able to take it because investment income makes up the difference. It's deciding to work part-time so you can pursue a creative passion, start a business, or spend more time with aging parents and actually doing it because investment income reduces how much you need from employment. Financial freedom from these investments is quiet confidence, it's options, it's reduced stress, it's a buffer between you and life's uncertainties. I've talked to dozens of people who achieve this, and they describe similar feelings. They work if they want to, doing things they find meaningful or interesting, not out of desperation. They sleep better. They have more patience with life's annoyances, because financial pressure isn't amplifying every small problem. They maintain perspective during economic uncertainty because they've lived through previous crises and watched their dividend checks arrive regardless. They know their portfolio survived 2008, 2020, and will survive the next crisis too. They're not spending 12 hours daily managing investments. Most spend maybe an hour quarterly reviewing positions. The rest of their time is for living family, hobbies, volunteering, travel, whatever brings them joy. That's what you're building toward. Not a retirement of leisure necessarily, though you could have that, but a life where work is a choice, not a necessity. Where financial decisions come from preference, not desperation. Where you control your time rather than selling it by necessity. These three investments, REITs, dividend growth stocks, and index funds, are tools for building that life. They're not magic, they don't get you rich overnight, and they require discipline and time. But they work. They've worked for millions of ordinary people over decades of market history. The question isn't whether these strategies can free you from job slavery. The question is whether you'll actually implement them consistently for the years required. Most people won't. They'll read this, feel motivated for a week, and return to old patterns. Money will flow through their hands for decades, and they'll retire entirely dependent on Social Security and hoping their health holds out. You can choose differently. You can start this week with whatever amount is realistic, even if it's just $100 monthly. You can automate it and let it run in the background while living your life. You can check in annually and watch the progress. And over the years and decades, you can build a portfolio that fundamentally changes your relationship with work and money. The starting line is this week, not when you get that raise, not when you pay off that debt, not when market conditions are perfect. Those are excuses disguised as reasons. This week, open the accounts, set up the automation, make the first investment. Your 55-year-old self is watching from the future, hoping you'll do it. Don't let that person down. Start building your freedom today.